Welcome back, everyone. I will speak a little bit about our approach to investments in Russia. If we look at Russia today, I mean, it's really the classical value case. It's around 60% of commodities in our funds. I really think this is a so-called inflation hedge. I mean, there will be talks about the effects on inflation on long-term yields and some volatility in the markets. I think that's probably given in the next 1 or 2 years. And probably investors would like to keep a certain part of the portfolio in more value kind of inflation protected type of exposure. So I think Russia is probably the best market or the best type of exposure you can get when it comes to this. In terms of valuation, well, Russia is up 31%, or the RTS is up 31%, the key index. And this means that Russia is now trading at 6.7 times earnings, but it was actually 8.3 times earnings in the beginning of the year. So despite the 30% return, the P ratio for the market, as you can see on the slide, is actually lower, significantly lower now. We heard in the first panel about the macro backdrop. I think it's fair to say that Russia is the most solid macro case of all emerging markets. Not necessarily the one with the highest growth. 2-3% growth is not spectacular, but on the other hand, it's very stable. I personally have been investing in Russia 20 years with this capital. I was based here before that. And we have a very robust team here in our Moscow office. I think it really makes a difference being on the ground, seeing all of the other market players, companies, etc. I spent my weekend with 20 other PMs running big money in Russia. And of course, you probably learn something from them. Maybe in some cases you will cooperate with them, etc. On the engagement side, I would say East Capital is the most active. Engagements can be everything from disclosure to a new dividend policy to even changing the general director somewhere. On the climate side, I think we are now recognized as a thought leader among the asset managers. We are leading many of these initiatives. We might be leading them on the behalf of some kind of pool of assets like Climate Action 100, but we are typically the ones on the ground leading them, and we are the face towards the company. And if you look on the right-hand side, you can just see the valuations for our fund. So the fund is now trading at 6.8 times earnings, 166% earnings growth for this year, and 8% dividend yield. The 166% is obviously because of partially cyclical recovery, but partially also because we have many commodity prices that have stabilized on a significantly higher level compared to pre-COVID. Gas was mentioned, but it's not only about gas. It's about a wide range of commodities. So overall in Russia, we have a very long track record, 23 years of performance. We analyzed 5% annual alpha since then. And this year we are at an 11% alpha. So this year is turning out to be one of our best years ever in terms of relative performance. You can see the index is up 22%, which is less than what I showed on the previous slide, because this is the MSCI Russia 1040. So it's a slightly different index with simply less of commodity names in it. And it's capped in a certain way, which means that this is what we can follow as a UCITS fund. In terms of how we have done versus peers, well, we are significantly the best fund year to date we're actually 3.5% above the second best fund. And I think in my career, I've never seen such a large performance spread between the best and the worst fund. And I also don't think that, the difference between number one and number two is so big. Obviously, this goes up and down over time, but I think consistency of performance is very important. So if you look on different time horizons, 1 year, 3 years, 5 year, we would be among the top funds on all of these time horizons. Basically, the areas marked in green here, these top quartile performance. And if you look on our peers, they are simply a bit all over the place. And if you look on some of our key peers, they're actually at the very bottom of the table, and there's actually consistently, unfortunately for them, not so good performance. So yeah, for Russia, I mean, Russia was an interesting story this year. So up until May, Russia performed, I would say, in line with global markets. It did relatively okay. It was up around 10%. But since then, the markets really took off. So it went from +10 to +31%. And there are 3 key reasons for that. First of all, improving geopolitics. Secondly, the value rotation I mentioned in the beginning. And thirdly, clearly the strong commodity prices. So in terms of geopolitics, I will not go through all of these events, but I think that the takeaway really is that Biden has softened his tone on Russia. And there was actually a removal of sanctions for the first time since 2014, when Biden basically gave a waiver on Nord Stream 2. So this was a small step, but it was a very important step to show the direction, i.e. that there will be hopefully no more significant sanctions from the American side. I think for sanctions, I want to admit that it's a very difficult process to forecast, but so far what we have seen is a more kind of constructive and engaging tone instead of one just kind of slapping sanctions on Russia. We also had Olga saying from Sberbank that the potential new sanctions are most likely going to be against individuals, i.e. not really hitting the market or the ruble in a significant way. On the commodity side, so it's a very kind of mixed picture. You can see that commodities on average are up significantly. Gas prices in Europe, I will repeat these numbers, they're up 641% since the beginning of 2020, and they're 321% year to date. I think Gazprom is effectively providing as much gas as it can to Europe. Nord Stream 2 is just about to be open, so I think this will put some relief into the system. More gas can be supplied. I don't think prices will collapse when Nord Stream 2 goes online, which is expected by year end, so probably for this winter season. But of course, it just technically means that Gazprom can supply more gas. So to illustrate this perhaps a bit more clearly, European prices for gas are now above $1,000 per 1,000 cubic meters. This is the highest, by far the highest level ever. I mean, you can see on the chart that they just keep on spiking, and the reason for this is really because last winter was cold, so part of the reserves were depleted. During the summer months, inventories in Europe were not refilled because it was actually very warm. So then you need a lot of gas for air conditioners in Europe. Carbon prices in Europe are also very high, and that's a function of a lot of coal that was supposed to be burnt, and is simply more efficient to with these kind of carbon prices to burn gas instead. And finally, if you look at the European market 2-3 years ago, there was a lot of LNG coming from the US. That LNG is now shifted all to Asia because Asian buyers simply paying more for that LNG. So Gazprom is by far the largest supplier to the European market. So what does it mean for Gazprom? Well, for Gazprom, they used to have this contract structure that they were selling on so-called oil-linked prices. That's no longer the case. They are selling 56% of their production on a kind of spot or semi-spot basis. So they actually do reap the benefit of these very high prices. If we look at the dividend yield, which is what both retail and institutional investors will be looking at, I think we are looking at a 15% kind of de facto dollar dividend yield for this year. And I think for next year, well, it's hard to tell. It depends how much can be locked in at these very high prices. But I would probably say in the range of 16 to 20%, around 18% if I was to make a guess. So very, very high yield. And this is despite the stock being up around 70% year to date. If we turn towards the global capex cycle, the by far largest increase in capex 2021 versus 19 was in utilities. So this is in renewables, solar and wind power. And if we look on Russia, Russia historically was seen as a gas and oil play, but it's actually, I think more today it's a metals play. We have as much metals as oil and gas in our fund. So for example, if we look on the demand for nickel is the key component in batteries for electric vehicles. The demand will grow from $3 to $54 billion. That is 30% of the total demand in 2030. So these are enormous additions in terms of demand, and there will be significantly less additions in terms of supply. Obviously, this would push nickel prices higher. If you look on copper, and copper is one of those themes that Goldman is pushing, the demand is from renewable kind of energy sources, 35 billion in 2020, that will grow to 143 billion in 2030. So, very, very large increases in demand for all sorts of metals, slightly different usage and slightly different dynamics. But Russia is a key producer and is the cheapest producer of many of these metals. If we turn to aluminium, this chart is a little bit complicated, but there are, first of all, a significantly growing supply for aluminium from electric vehicles. So aluminium is a light metal. It's better to build a car that needs not too much energy from aluminium than from steel. But you also need it in certain solar installations. So this means that something like, I think it's 24% by 2030 of current production would be from renewable sources. So you're adding a lot of demand, 24% of additional demand from electric vehicles and from solar. So only on that, the base price of aluminium should probably go up, right? If you have 24% of demand. But there's a second price component that this is more complicated. So until 2030, of the total demand of aluminium, 18% will be from aluminium with a low carbon footprint. So for example, BMW might say, well, actually, we will only build cars from aluminium with a low carbon footprint because that's what our clients want. That's probably the way European car makers are going to think. So we own a company called Rusal. Rusal is de facto the aluminium producer of Russia. They are producing aluminium from hydropower. 40%, for example, of the world's aluminium is produced by coal power, which is obviously not particularly clean and with a much higher carbon footprint. So most likely, because of the demand for green aluminium, not only prices will go up, but there shall be a spread between the price for regular aluminium and the price for green aluminium. You speak about green steel, you're going to see the same trend as an aluminium, but the difference is that this aluminium already exists. So that spread will very, very likely increase significantly over time. So yeah, if we look on the price forecasts, I think it's hard to say exactly what prices will be, but it's clear that ways up we'll see higher prices, and again on top of that a positive spread then for the green aluminium. So if we put these numbers into the valuation case, the free cash flow yield for the aluminium business, if you look on the result for next year, is around 20%. The free cash flow yield is around 33% for 2023. But on top of that, this company owns a 25% stake on Norilsk Nickel, which is one of the world's largest nickel producer and also copper producer. So they're getting the dividends. So if we add this dividends on top of the free cash flow yield from the underlying business, we are looking at 30% or 31% free cash flow yield for next year, or a 49% free cash flow yield for 2023. I would say that these are very realistic numbers. There are some brokers that have even higher numbers than we do. In terms of PE, it's PE 2.3 for next year, which I would say is very cheap for a company that is probably riding a wave of increasing prices going into the future, and it's riding this kind of renewables wave. Our numbers to the left here, you can also see how we are versus consensus. So for example, for 2021 we are 47%, also 2022 I guess it is, we are 47% above net income. For next year is more than 100%. In terms of investment process, and I will keep this quite short, I'm happy to go through this at length if someone wants to in a separate call. So the first criteria is structural growth. I think we showed in terms of aluminium demand here that this is clearly a structural growth case. It's part of the renewable kind of value chain. In terms of long-term competitive advantage, well, if you looked at Rosal as an example, this is a bottom 10 producer in terms of cost, 10%, or bottom decile, bottom 10%. Strong free cash flow. Well, I think that was pretty clear with the 30% free cash flow yield. Different due to consensus. I think that was also clear that our numbers are far above consensus, even though some brokers are now actually moving their consensus upwards towards our numbers. Reasonable valuation. Well, I think P 2.3 for next year is very reasonable. And finally, high ESG standards. So yeah, we do make a scorecard. We do make an assessment here. But I think overall, it probably also fits into the intuitive ESG assessment of aluminium produced in a green way or from renewable energy. So these 6 criteria is something we have been using since 2015 in a very kind of structured way. We've always been working with top-down themes as well, but I would say that in the past 2 years, we probably paid more attention to top-down. It has been very quick moving markets. You need to refresh your view on what's really happening. Everything from geopolitics to rates, triggers such as index inclusions might sound boring, but it might give you alpha. So we also incorporate this into the process. And this chart just shows you the correlation between the return and the earnings revision. So in short, we are trying to say with our investment process, we want to be better than the market. We want to be different to consensus. Of course, as they say, consensus moves your way, then you make performance. I think that's perfectly clear. So when the earnings were upgraded, the stock also performed, right? So this is how we think, okay, where do we think that, something will do better than expectations? This is probably how we should be positioned from a tactical point of view. Again, also looking, of course, at our 6 criteria. So in terms of turnover, we aim to have 20 to 40% turnover in our fund. We have been significantly above that, 60 to 80%. And that has paid off. We have very good performance. I would probably say that when markets normalize, the turnover will come down a bit, but probably we're going to live in a slightly more difficult and slightly more fast-moving world. So probably we should have, turnover closer to maybe 40 or 60% than the 20, 40 that we've had in the past. I think we will probably end up there. In terms of trading, I will not bore you with the details here, but the big trades we did, they generated close to 4% alpha in 12 months. That's a lot of alpha only on the big trades, right? So I think the point here is very simple. You need to be prepared to change your mind and actually do quite big trades if you want to continue to generate alpha in this type of markets. I will not mention anything on macro for Russia. I think we went through that on the panel. In terms of Kaspi, so Kaspi is a completely unique company. We will hear more from the CEO, who's also one of the biggest owner and a very wealthy person these days. It is a combination of Amazon and the largest consumer bank in the country, and it's all in one app on your phone. The daily usage of this app is the same as WhatsApp. It's something that people check every day. Close, at least young people check it every day. So I haven't seen anything close to this in emerging markets. And if we look on the different business segments, in terms of revenue growth and from the marketplace, so this the Amazon, they have a 60% plus market share in e-commerce in Kazakhstan. So that grew 250% year on year in the second quarter. Admittedly, this is probably from a low base, but still. The payment side here, they're actually revolutionizing the way that you pay for things. So typically, Visa and MasterCard and paying with a payment terminal is the standard way. But in Kazakhstan, they have simply changed the system. So now you pay with a QR code, and the fee for the merchant by using this QR code is significantly below what Visa and MasterCard would choose. So, most of the payments are now done this way, and Visa and MasterCard are losing market share, and Kaspi is gaining that market share and also gaining that revenue. And then they all have also a more, I would say, traditional consumer lending side, but this is of course also how you get the clients, then you can maybe keep them in the system. In terms of numbers, well, we made more than 200% on the stock since the IPO in October 2020. That's great, but it is still trading at only, I would say, P16 for next year, and that's with a 6% dividend yield for next year, because they basically pay out all the money they make. They have a very asset-light model, and I think that's also unique because globally, if you look on the tech stocks, they typically reinvest and they don't pay dividends. For these guys, it's different. They have a very asset-light model, so they can actually afford to pay dividends. Again, the CEO will probably present this company better than I will do, but I just wanted to give you like a small education because it's such a unique company. Yeah, on the climate side, David mentioned these numbers. So, in terms of reduction of emissions, our initiative is actually leading to 79 million tons less of greenhouse gases, which is equal to 130% of the total emissions of Sweden. I mean, I think these numbers are worth repeating. So of course, it does mean that we own these companies, but if we wouldn't own them, we also could not affect them and push them in the way that we're doing now. Finally, then on the fund. The fund is with an underlying dividend yield of 8.3% for this year and 9% for next year. I think this is probably a bit understated. I think it's going to be higher than that. P is 6.8 this year and P is 6.5 next year. On the earnings growth side, again, it's going to be a bumper year this year and lower earnings growth next year. So 166% this year. But I think that the point here is also that as Olga from Sberbank said, you're also seeing this retail inflows. So I think you're going to see a lot of people actually coming in and starting to push this market with retail money, and that's already happening, right? So I think it's a slightly different market, a market with lower volatility than you also saw in the past, because I think in the past Russia was this super volatile market that either lost 50% or gained 100. I think this time around it's just a different nature of the market with lower volatility, better governance, and I would probably say that better managed companies overall.